Have you ever found yourself wondering how your small business measures up against others in your industry? It's a common dilemma for many small business owners. You're putting in the hours, you're hustling, but without clear benchmarks, it can be tough to tell if you're thriving or just getting by. That's where the concept of financial benchmarking comes into play. It's a game changer, really. By comparing your financial performance metrics, like revenue, profit margins, and expenses, to industry standards, you can uncover some valuable insights into what's working and what's not. So, what exactly is financial benchmarking? Simply put, it's the process of comparing your company's financial metrics against those of your competitors or industry averages. This analysis can help you pinpoint your financial strengths and weaknesses, set realistic performance goals, and adopt best practices that can enhance your efficiency and profitability. Think of it as a strategic tool that ensures your business's financial health aligns with market expectations while driving continuous improvement. Now, let's break down the different types of financial benchmarks you can use. First up, we have internal benchmarks. This involves looking at your current performance and comparing it to your past performance. It's like taking a trip down memory lane to see how far you've come. For instance, if you compare this year's sales to last year's, you can gauge whether your marketing strategies are effective or if there's room for improvement. It's a great way to set realistic goals and make informed adjustments for the future. Next, we have external benchmarks. These compare your business performance to other businesses in your industry. This gives you a broader context for your performance, helping you understand where you stand in the market. Knowing, for example, the average profit margin in your industry can help you figure out if you're over or underperforming compared to your peers. Then, there are competitor benchmarks, which involve a direct comparison of your financial metrics with those of specific competitors. This is crucial for strategic planning and understanding your position in the competitive landscape. If your main competitor has significantly higher revenue, it might be time to investigate what they're doing differently and explore ways to enhance your own business practices to close that gap. We also have best-in-class benchmarks. These compare your business to the top performers in your industry. Aiming for these standards can drive innovation and improvement within your organization. By identifying the practices of the best companies and striving to match or exceed them, you can achieve substantial growth and maintain a competitive edge. Operational benchmarks focus on the efficiency and effectiveness of your business processes. Measuring the cost per unit produced against the industry average, for instance, can reveal inefficiencies and opportunities for cost savings. By addressing these areas, you can enhance overall productivity and profitability. So, why should you care about financial benchmarking? Well, the benefits are numerous, especially for small businesses looking to grow and thrive in a competitive environment. For starters, it highlights areas where your business can improve. By understanding both your strengths and weaknesses, you can implement targeted strategies to enhance performance. For example, if benchmarking shows that your inventory turnover is slower than industry averages, you can take steps to optimize inventory management, leading to improved operational efficiency. Having accurate benchmarks also allows for informed decision making. Rather than relying on gut feelings, you can make data-driven decisions that align with industry standards. If you know the industry standard for marketing spend as a percentage of revenue, for instance, you can allocate your budget more effectively. Benchmarking also gives you a competitive advantage. By continuously monitoring and adapting to industry trends, you can stay ahead of the competition. If you discover that competitors are leveraging new technologies to reduce costs, you can explore similar innovations to maintain your edge. Setting goals becomes much clearer with benchmarks as well. They provide a framework for setting realistic and achievable business goals. If the average growth rate in your industry is 5%, for example, setting a goal to match or exceed this rate gives your team something concrete to strive towards. And let's not forget about resource optimization. Benchmarking helps you allocate resources more efficiently by identifying the most impactful areas for investment. If companies with higher customer retention rates invest more in customer service, for example, you might decide to allocate more resources to improve your customer support. Now, while financial benchmarking has its advantages, it's also important to be aware of its limitations. One major limitation is data availability and accuracy. Small businesses often struggle to access comprehensive and up-to-date industry data. Publicly available data might be outdated or not directly comparable due to differences in accounting practices. This can lead to inaccurate benchmarks that don't truly reflect your business's situation. Another limitation is the differences in business models. Even within the same industry, companies can have vastly different strategies and operational structures. A small retail business focusing on niche markets, for example, may have different cost structures compared to a large, general retailer. Benchmarking against such dissimilar businesses might not yield meaningful insights. External factors also play a role. Benchmarks don't account for economic conditions, regulatory changes, or market trends that can significantly impact performance. A benchmark that looks good in one context might be irrelevant in another, so it's crucial to consider these external factors when interpreting your data. And let's not forget about the short-term focus of many financial benchmarks. They often emphasize quarterly or annual performance, which might not align with long-term strategic goals. Small businesses with a vision for long-term growth may find that short-term benchmarks don't serve their overall objectives. Then there's the issue of resource constraints. Implementing and maintaining a benchmarking process takes time, money, and expertise, resources that many small businesses may lack. This can lead to a superficial use of benchmarks that don't translate into real improvements. Standardization issues also come into play. Different industries and regions might have varying standards for financial metrics, making cross-industry benchmarks less reliable. A small business operating in a local market might find that global benchmarks don't accurately reflect its unique challenges. Lastly, there's the potential for misuse. Businesses might focus too narrowly on specific metrics without considering the broader context, leading to unethical practices or short-sighted decisions. It's essential to use benchmarks as tools for insight rather than as definitive targets. So, how can small businesses effectively benchmark their financial performance? Here's a step-by-step approach. First, identify your key performance indicators. These are quantifiable metrics that reflect critical aspects of your business performance. Common financial KPIs include revenue growth, profit margins, return on investment, and cash flow. Selecting the right KPIs ensures you're measuring aspects that directly impact your success. Next, collect your internal data. This involves gathering financial statements, performance reports, and any other relevant documents. Make sure this data is current and accurately reflects your operations, as it will serve as the baseline for your comparisons. Then, research industry benchmarks. Look for reliable and up-to-date data that represents the performance of similar businesses in your industry. This could come from industry reports, trade association, or financial databases. With your internal data and industry benchmarks in hand, it's time to compare performance. Analyze the differences and identify areas where you're performing above or below industry standards. Use visual tools like graphs and charts to make these comparisons more intuitive. After identifying performance gaps, analyze them in detail. Understand the underlying causes of discrepancies between your performance and the benchmarks. This analysis will help you set realistic and specific goals for improvement. Based on your analysis, develop action plans to address the identified gaps. Outline specific steps, assign responsibilities, and set timelines for implementation. Make sure these plans are realistic and achievable considering your resources. Once your plans are in place, implement the changes. Effective implementation requires clear communication and continuous monitoring. Ensure that all team members understand their roles and responsibilities. After implementation, continuously monitor your progress against your goals. Use the same KPIs and benchmarks to track improvements and measure success. Regular reviews will help you identify any deviations from the plan and make necessary adjustments. Finally, remember that financial benchmarking is an ongoing process. Regularly refine your benchmarks and repeat the process to ensure your business adapts to changing market conditions and strives for continuous improvement. Who performs benchmarking in a company? It's typically a collaborative effort involving various stakeholders. Financial analysts collect and analyze the data, while the accounting department provides the foundational financial information. The management team uses the results to make strategic decisions, and operations managers focus on improving efficiency. Marketing and sales teams evaluate their strategies based on benchmarks, while HR departments ensure competitiveness in compensation and benefits. And data teams support the process with the necessary technological infrastructure, and external consultants can provide specialized expertise. Now, let's talk about some financial benchmarking ratios that can boost your company's performance. The gross profit margin measures the percentage of revenue that exceeds the cost of goods sold, indicating how efficiently you produce and sell your products. The net profit margin shows the percentage of revenue that remains as profit after all expenses. The current ratio measures your ability to pay short-term obligations with current assets, while the quick ratio assesses your ability to meet short-term obligations using your most liquid assets. The debt-to-equity ratio evaluates the proportion of equity and debt used to finance your assets, while return on assets measures how efficiently you use your assets to generate profit. Return on equity indicates how well you're using investors' funds to generate profit. Inventory turnover measures how often you sell and replace your inventory, and accounts receivable turnover assesses how efficiently you collect revenue from credit sales. To wrap things up, financial benchmarking is a vital tool for small businesses striving to succeed in a competitive marketplace. By methodically comparing key financial indicators against industry averages, you can gain invaluable insights into your operational efficiency, profitability, and overall financial health. With the right tools and a solid approach, you can make informed, data-driven decisions that will guide your business towards long-term success. So take the plunge into financial benchmarking and watch your business thrive.